We had a volatile day in the real estate market because CPI Consumer Price Index, which is an inflationary measure of inflation, came out, and the number now is higher than what we expected, what analysts and experts expected. CPI, both the headline number and the core number, which strips out volatile food and energy prices, both rose by 0.4%. So our inflation rate, according to CPI right now, is 3.5%. The Fed wants to see that number trending toward 2%. 2% is the target number that the Fed has. To give you some perspective, at its peak in 2022, the headline inflation number was at 9.1%. So we made a lot of headway since 2022. But we're not seeing a continuing trend into 2%. So that's what happened. What are the key drivers? Well, the measurement of CPI is a pretty complex measurement, but there are three big kind of drivers of it right now. And the first is shelter costs, which is rent. They're just increasing, and it's really driving this inflationary number. And candidly, I think that's going to be a little sticky for us as we go through time over the next several months here, because when you measure these numbers, you're comparing year-over-year numbers. So you take basically last month's number and you compare it to a year ago's number. And the shelter costs a year ago were pretty low. And so we're going to have a hard time replacing current numbers with lower numbers from a year ago. So that shelter cost is going to continue to drive it. The other two big headliners is the cost of energy, gas. That doesn't surprise anybody. And then automobile insurance is a big driver right now on inflation. So we get a bad number. Mortgage interest rates, bonds, they hate inflation, and so the market, rightly so, reacts negatively. But I still think there's some strong fundamentals and some strength in the real estate market. I want to be clear here. I'm not advocating inflation. I don't think it's good. It's not good. But to take a kind of a panic mode or an alarmist mode that there's no opportunity in real estate, I just don't think that's really a balanced, pragmatic view, because I think if we look at the fundamentals of what's going on in the real estate market right now, there still is opportunity, even though we're in a difficult market. So what are those fundamentals? Well, first and foremost, everybody needs to remember, if we do go into a recession, real estate, set aside 2008, historically does very well in recession, and it makes intuitive sense because when you go into recession, the Fed's going to cut rates to stir on and accelerate economic activity, and that'll be good for real estate. So recession necessarily isn't doom and gloom on what happens in the real estate market. The second thing, and this is the big fundamental that's important, is that you have to remember we're in a low inventory, high demand market. Now, inventory's improved recently, I don't deny that, but that low inventory, high demand market really adds stability in the marketplace, and that's a strong fundamental that we need to remind ourselves of as we try to figure out and advise our buyers and sellers, or if you're a real estate agent, or if you're a buyer and seller, you got to understand that it really is a stable market from that perspective, and that's important. The other parts is you have to remember, in a rising interest rate market, that slants or favors a buyer's market. So as the interest rates are higher, things like seller concessions, which can be used for closing costs, or importantly, temporary buy downs on interest rates or permanent buy downs on interest rates. So as we get into these higher interest rate markets, one of the fundamentals of that market is opportunities for buyers to expand their negotiating power and leverage and take it to their advantage. Because look, you lock in a rate with a buy down, you may get a somewhat attractive rate. And remember, you're still going to refinance that mortgage X period down the road when rates improve. The other part that's important is, go back when interest rates were super low. You were having to give appraisal waivers, and you weren't getting any inspection items repaired at seller's expense. So one of the important reasons why you want to hire or have a representation if you're a buyer is that you want to be able to negotiate some of the important parts of the contracts, like appraisals, and you want to negotiate inspection items. So the fundamentals of this marketplace still, I think, remain pretty strong. Another component is, you're gonna make your bid at maybe the asking price, or maybe you're gonna bid below asking price. You're certainly not going to see bids for properties well over ask. I know that's been happening a little bit in the previous months, which was good, but with this rise in interest rates, I probably see many more bids going in at the actual asking price. So the fundamentals that I really like to see going on in the marketplace right now is Stable inventory market, meaning low inventory, high demand. So we have a stable price structure in the real estate marketplace. Real estate does pretty well in times of recession. I think that's great. Negotiating the components with the sellers, things like seller concessions for interest rate buy downs, temporary buy downs, permanent buy downs. Also, you may be able to negotiate repairs on inspection items when that's appropriate. So the fundamentals of the marketplace, I think, are still here, and I think there's good opportunity. Again, I'm not sugarcoating this. I would love to see declining interest rates. It'd be better for everybody, but there's still opportunity in this marketplace. Look, love to continue the dialogue on this. Call me anytime, 720-419-3016. Happy to assist if you're in Colorado, Texas, or Florida with any of your mortgage financing. Thanks for checking out my content.